All right, guys, let's quickly take a look at that upcoming data today for the US. We've got the ISM, manufacturing, and the JOLTS data. Now, we do have the ADP coming up before that, but as you guys would have seen from the recent videos that we've done, we're not really focusing on the ADP from a tradability point of view. Over the last 8, 9, 10 months, it just hasn't given us any edge to trade. We've had big deviations coming out with the ADP. I mean, we had some shocking numbers. Remember that one we had back last year, that 543 one. Then we had that 307 one. We had some real big shockers coming out of the ADP. And what did the markets do on the back of majority of those prints? Absolutely nothing. It was just a dud and nothing burger. We're not going to focus our attention on this. Now, you can ask the question that, okay, but what if we are wrong? And what if this time the ADP actually does move the markets? You know what? Then I'm happy to sit out of that move. I'm happy to miss out on that move, but we can't trade something that's low probability, right? We can't trade something that we know won't move the markets. That's like saying, okay, you know, we've got balance of trade coming up. If that's a monster deviation, will we trade it? The answer is always going to be no, because it never moves the markets. Yes, there will be that one time maybe that the markets decides to pay attention to it and trade it. But whether that's going to be today, I won't be putting my money on ADP. Again, even if it's a big deviation and it moves the markets, we have ample of examples over the last few months where we've had big deviations and it's done nothing for the market. So I am completely ignoring the ADP. The only thing we're going to be using the ADP for will be, like we always do, using it as an additional input going into Friday's NFP to give us an idea of where the market's expectations might be leaning for NFP, but we won't be trading the ADP at all. Now, let's take a look then at the ISM manufacturing and JOLTS data. These two events are released at the same time. So as usual, when this happens, it means we want to have the outcome of both in the same direction. Either a big miss in both or a big beat in both. A mixed print just won't be attractive to trade. Now, going over a few of the basics as we always do, when it comes to the ISM manufacturing and the ISM services PMI, we never just look at the headline reading. That's the manufacturing PMI or the services or non-manufacturing PMI. We always have to look at the sub-indexes as well. We need to include that in our analysis. That means looking at the headline first, yes, but then we also need to look at the prices paid, the employment sub-index, and the new orders index as well. We ideally, guys, want all of these things to show us the same thing, either a strong move across the board or a strong miss across the board. That normally gives us the best edge. Now, apart from that, it will be a little bit tricky to trade the ISM manufacturing and the JOLTS data today because we have the FOMC coming up a few hours after that. So that means that if we are going to have a trade out of these two, the deviations needs to be sexy enough to see the markets excited about taking additional risk so close to the FOMC. Also, you know, usually when the dollar is as stretched as it is now, you know, if you take a look at the, let's go to the positioning data here. Normally when the dollar is this stretched, I don't want to be long the dollar, right? When it's this stretched, we wouldn't really want to be buying it on a beat. But since sentiment is bullish for the dollar after yesterday's employment cost index, which I think is driven by hawkish Fed expectations heading into tonight's decision. Look, if the sentiment is bullish, as I think it is, and the markets are pre-positioning for a hawkish Fed, which I think they are, then a huge upside surprise could give us a really good scalp long opportunity in the dollar. So yes, it is stretched, and yes, there is a risk that, you know, the beat might be short-lived because of that stretched positioning. But if the sentiment agrees and pre-positioning agrees, if we get a solid, strong data point today, I don't see positioning and stretch positioning being enough to stop the markets from giving us a short-term rally to the upside. So I will be open to both upside and downside for the dollar because sentiment is bullish, because we've seen strong pre-positioning. If we haven't seen either one of those two, I would have been more cautious as we've been over the last few sessions. But with sentiment bullish, pre-positioning bullish, the Fed expecting a hawkish Fed, if it's a strong number, a decently strong number across the board, I think upside could be attractive. Also, the good news is that, we were very concerned. Well, I was very concerned with possible, intervention risk going into those key levels for dollar yen. But, good news is we are miles away from 160, which is probably the new line in the sand. They're probably not going to intervene when we get back up there. If it's like 2022, they'll probably let it go even higher. The bottom line is we are still miles away from 160. So if we were at 160, I would probably say, you know what, let's just be a little bit more patient. But we're miles away from that. At 158, we've got a good 200 pips higher that we can ride if it's a strong enough number without worrying about intervention. So I won't be too concerned about intervention. It doesn't mean they won't do it. Just means the odds of it happening are lower because they have shown us, firstly, that they are very reluctant to act. And secondly, they did a pretty weak job intervening on Monday. That's not how you show strength. That shows weakness. So that means I won't be too concerned. And that means I think there could be both upside and downside opportunities as long as they are short term and as long as the deviations, as always, is big enough to get the markets excited ahead of FOMC. Now, having said that, after yesterday's employment cost data, I do think the more attractive short-term opportunity would be a big beat across the board. I just think that feeds more naturally into yesterday's sentiment. It feeds more naturally into the move we had in yields, the move we had in equities, the strong employment data we had yesterday. I just think it feeds more naturally into what we're seeing right now. There is also a risk that the markets might just choose to ignore a negative print today because they are focusing on the FOMC. They could ignore the other recent negatives that we've seen and just choose to focus on the positives. So there is risk that we just need to keep in mind going into this. Now, think about it. The markets have largely, the dollar at least, have largely ignored the other negative data points we've had recently. Think about I looked at this earlier. Where's my charts? Here we go. Look at the S&P flash PMIs, both of them contracting quite a bit in their recent print. We looked at this earlier today as well. Where's my other charts? Let me just quickly go there. While we're on that topic, the dollar, come on, why can't I access this? Oh my word. Okay, just take my word for it. We had a huge miss in consumer confidence yesterday, huge miss in the Chicago PMI. We had the surprise miss in Q1 GDP. We had the NFIB Business Optimism Index, which had a huge miss to the downside as well. So, we have had pretty soft data points, and obviously the hard data with the GDP as well. And the dollar has largely ignored that. So, I do think there's a risk that the markets might want to just ignore any bad print we get, like a big miss in the ISM or a big miss in the JOLTS. They might want to ignore that and rather just, focus on the Fed. So there is a risk, and that is just something that we do need to keep in mind going into that data point. So what are the markets expecting from today's print? Consensus is looking for a slowdown in both, but not a big one. If you take a look at the manufacturing headline, expected to decelerate from 50.3 to 50. Prices paid to go from 55.8 to 55. And job openings to go from 8.7 million down to 8.6 million. So not a big deceleration expected here. So what do we need to see to give us a big deviation that's attractive enough to trade on these? Let's start with the JOLTS data, which I think will be watched closely given the recent softness we've seen in other labor data, like the S&P Global Services Employment Index. That dropped to the lowest level since COVID. We had the NFIB hiring plans. Let's just see if I can access this chart now. It'll be fantastic if Refinitiv just allows me to do that. Let's just see what's going on here. Come on. There we go. So hiring plans on the NFIB. Look at that chart. It's crazy. What small businesses are looking at from a hiring plans perspective. Apart from the COVID drop, that was huge. We've mentioned the S&P Global Services Employment Index that dropped hard as well. So I do think there's going to be a lot of focus on employment data purely because of that recent softness that we've seen in others. Now, coming back to jobless claims, markets are expecting a 8.7. You know, let's round it to 8.7, 8686. Let's start with a beat. Even though 8.8 million is the maximum, and even though I think that could be good, really ideally for a beat, guys, I want to see us above that November 2023 peak, and I want to see us above 9 million. Breaking above 9 million not only gives us a break above the market's maximum expectation, but we're also breaking that psychological barrier. Now we're at 8.6 million. Imagine the headline, job openings accelerates back to 9 million. If we get that type of beat, I think 9 million or higher would be a good beat to look for. I mean, if job openings are expanding while inflation is surprising higher, that should get the market and the Fed nervous, right? So I think 9 million or higher could be good for a beat. For a miss, I think a print below the minimum should do the trick. The minimum is 8.5. What does that give us? It gives us a new cycle low, and it's also a miss below the minimum. So 9 million or above, 8.5 million or below, I think should be good enough for a beat and a miss on the JOLTS data. So what about the ISM? Now, you know what? Let's actually go back to this. Here we go. All right. So for the ISM, the challenge with this one and the services one that we'll be getting on Friday is that we don't get the high and the low estimates for all of the numbers. We only get the estimate for the headline and the prices paid. So that means for the other two, the employment and the new orders, we need to look at the priors to give us a tradable opportunity. Now, notice on the chart, coming back to that chart, notice on this chart, for these four, that we had a move higher across the board last time. Every single metric pushed up. So we would ideally want to see all of the priors being taken out or pushed lower on a miss, right? We don't want to see a miss that is still higher. We want to see a move lower across the board on all four headlines, ideally. And for a beat, we want to see new highs in all of them as well. That's very simple. But having said that, if we go back to the calendar year, which is important, having said that, a move below that magical 50 number, talking about a miss, for the headline and for new orders back below 50, that'll be a decent miss, because anything below 50 shows industry contraction, above 50 shows industry expansion. So seeing all three of them, meaning the headline, the employment index and new orders all back below 50, I think that could be good enough for a miss. I don't think prices paid gets below 50. I mean, at 55, it's pretty high, but should we be so lucky to see all four of them below 50? I mean, that'll just add a lot of conviction to a miss to the downside, right? So what about a beat? What are we looking for a beat? Firstly, a move above the maximum expectation for the headline. I think that is that'll be a bare minimum that I want to see. And also a move above the maximum for prices paid. Look, we're not far from that for either one of these two. So a move above the max, I think, is bare minimum. For new orders, we would ideally want to see not just above the prior though, because if you go back to the chart for new orders, last time round, new orders didn't make a new cycle high like we saw, or a new recovery high like we saw with the prices paid and the headline. New orders actually had a peak back in January, and that peak comes in at 52.5. So I ideally want to see new orders above 52.5 as well. So that we see new upside, a breakout in all of these across the board like we had last time. I think that'll give us, that'll be decent enough for a beat. And obviously with all the focus on the recent miss in some data for employment, if we can see employment bouncing back into 50, I mean, that'll just be the perfect one, right? I mean, if we can see these four back above the market's max, new orders above 52.5 and employment above 50, that'll be a fantastic beat to potentially trade. So what would we expect from different asset classes, assuming we get that big miss and assuming we get that big beat? Let's start with the miss. Let's just say we get that huge miss. What we would expect from the dollar is downside. We would expect yield downside. We would expect equity upside, and we would expect precious metal upside as well. So for a trade here, let's go back to FX for a second. For a trade, If we get a huge miss pushing the dollar lower, I actually think euro dollar upside could be interesting here. The euro has held up fairly well over the course of the last 2 days. It's just about the second, third strongest currency today. And it's all been down, in my opinion, based on that solid data we had for the Eurozone yesterday. So I think euro dollar upside could be good. Look, I would also like something like the Aussie versus the US dollar for upside. The challenge with that, though, is, copper has decelerated quite a lot. I'm just a little bit concerned. I don't like Aussie as much as I do the euro, just because we have copper, so much lower. Look, a miss could see copper higher again, so there could be an option, but I'm going to stick to euro dollar at this stage. Now, we could also, in other asset classes, we can also look for short-term upside in something like precious metals, but personally, guys, I'm staying clear of commodities on the long side right now. I would consider them short, but I'm not going to consider them on the long side, and I'll explain why when we talk about a beat. So there could be upside for precious metals on a miss, but I won't be looking to trade that. In terms of equities could also be good for a very short-term upside in equities after yesterday's decent dip that we had to the downside. And again, we're not going to be looking for this to go back to new, fresh, all-time highs. It's going to be a short-term trade, but on a solid miss, big miss, it could be enough to just pop us back into that implied volatility high. It could be good enough for a short-term scalp is what I'm trying to say. Again, it's going to be short-term because we're going into the FOMC. If the markets are expecting a hawkish Fed, which I think they are, if we get a big miss that we trade, it's going to be a short-term trade. If we're lucky enough to be able to move to break even and stay in the trade going into the FOMC, that's fine. But we don't want to be holding massive open risk on a long in equities going into the FOMC, because if they do smash it out of the park on the hawkish side, that's not going to be a fun trade to be in at that time, right? So just keep that in mind. Now, what about a beat? Assuming we get that nice strong beat, what would we expect? Well, across asset classes, the exact opposite. We would expect on a beat, we would expect equities lower, we would expect precious metals lower, we would expect yields higher, and we would expect the US dollar higher as well. So from a tradability point of view, let's come back to precious metals. Because I do think that even though I don't want to trade equities long on a miss, I do think a short on a beat makes sense here for gold. Why do I say that? Well, firstly, take a look at risk reversals. Risk reversals suggest that there is still a lot of downside risk, just looking at the differential between, or divergence rather, between spot and what risk reversals have been doing. Apart from that, let me just quickly do this. Apart from that, we are sitting right on the 200 for the 4 hour. And look at what we've seen from a pure basic trend structure point of view. We've had lower lows and lower highs. So we're showing momentum is breaking down. Trend structure is breaking down. We've traded below the low from the 23rd from last week. So if we get risk reversals point lower, momentum point lower, trend points lower, if we get a super solid beat, I think downside in gold could be an option. Implied vol low comes in pretty tight though at 22.69. If it's a beat, it could even be something we can trade into the FOMC. That means that we could look for something closer to 22.50, maybe even 22.40. I think that could definitely be an option to consider in a session like today. Let me just quickly hide that again, because that does take away quite a lot of the size. All right, so that is that's precious metals. Let's quickly take a look at when it comes to equities. I'm a bit more reluctant on shorting equities on a beat. I do think they're going to go down if we get a strong beat. I just think that, I'm skeptical of equity shorts. Doesn't mean it can't be a trade. It just means that I will be playing that a little bit more cautiously. I would prefer being short this than being short this, right? I would prefer being short gold than being short equities, but that could also be a possible trade. On the FX side, it's obvious dollar upside could be a good option, would be our option. And there, I do think Aussie US dollar downside could be interesting, because if we have a strong beat, it should be enough to take commodities even lower, equities even lower, and that should weigh on the Aussie dollar. We're testing resistance here around that 64.87 as well. So nice strong beat, forcing those things lower should force the Aussie dollar lower. I do know it's the strongest currency on the session today, but that could change, right? That could change drastically if we see a big enough beat. There, trading into the FOMC, we could look for a move back down towards 64.50. the implied vol low coming in at 64.40. Either one of those could be good for a possible option. We could even consider the Kiwi, at these levels, the Kiwi for possible downside back into that 58.60 region. That could also be on the cards. We could also consider pound dollar. Pound has been weak from yesterday. Look at this from a technical point of view. Moved right up into that 125 psychological level. Now we're rejecting from it. So pound dollar downside back down towards 124, 124.30, 124.37. That could be good as well. Look, dollar Swiss and dollar CAD upside could also work. I'm concerned about both of those from a positioning point of view. I mean, the CAD is pretty stretched at these levels. The Swiss franc even more so. Look, these things shouldn't matter from a scalp point of view for the short term. I'm cautious of it, right? So I'm going to ignore these two and I'll be placing my focus on the Aussie as well as the Kiwi. Now, after going through all of that, we just once again need to acknowledge the proximity to the FOMC. That does mean, guys, that there is a risk that even if we do get that great beat and that great miss that we would want to see, there is a risk that the markets opt to ignore it all and just focus on the FOMC instead. That means manage your risk accordingly going into the FOMC. I'm not going to go Rambo on this thing. I'm going to be on the lighter side when it comes to risk, because there is a chance the markets looks at it and says, yeah, okay, fine, let's wait for FOMC. And that is a risk that we just really, really need to be aware of.